Coming up on today's episode.
There are huge benefits to fixing a rate like that when they're low and competitive, and you don't have to fix all your loan. You can do a portion of your loan. You can you can have split loans, and it's just important to understand. So you lose an element of flexibility when you fix.
Yeah.
In the sense that most banks don't allow offset against a fixed rate loan. So a lot of people don't understand that.
Yeah.
They also don't understand that they can't just fix, the variable rate's this, I'll fix it for that.
Oh, yeah.
That's not how it works. There are particular fixed rates for 1, 2, 3, 4, 5 years, and they are not the variable rate.
Yeah. Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together.
Hey, I'm Charlie Coleman from CC Mortgages. I've been on the No BS Real Estate Podcast today with Jo, and we've been talking about the mindset shift from going from getting a mortgage and getting a home loan and pre-approved to actually once you've got it, and how you can manage your money and have a ongoing positive mortgage mindset. Let's get into it.
Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Jo Agresta. Now, today, I'm joined by Charlotte, or Charlie Coleman, Principal Mortgage Broker at CC Mortgages. And today's episode is for the first-home buyers who are so focused on getting approved, finding the right property, and getting the keys that they may not have had much time to think about what comes next. So, because once settlement happens, the loan becomes real. The repayments start coming out, interest starts getting charged, the offset account is sitting there confusing everyone, the loan balance might barely move at the beginning, rates can change and repayments can change. And suddenly, you're not just saving for a home anymore. You're managing a mortgage, a property, your savings, your bills, and your actual life. So today we're talking about how first home buyers can become home ownership ready, not just loan ready. So we'll unpack what buyers are often underprepared for after settlement, how offset and redraw accounts actually work, and whether repayment frequency matters, what happens when rates go up, how do you think about buffers after spending your savings, and when you should re-engage your broker after the loan settles. So without further ado, Charlie, welcome to the show.
Thanks, Jo. Happy to be here.
I'm actually so excited because, we started catching up a couple of weeks back, and when I started hearing about all your experience and the way you speak about, mindset, and we were trying to say, what should we talk about on the episode? I thought this was one, oh my God, I haven't done it before. Yeah. Yes. And it's so important.
Yeah.
Because you've seen this your whole career, I think, like people transitioning from I've saved really hard, I've done all the hard yards, and now, oh crap, I own the mortgage.
Yep.
What do I do?
Correct. Yeah. And I've been there myself too.
Oh, yeah. I think we all have.
Yeah, exactly.
And, part of that too, I think the best place to start is, your background. We want to know a bit more about you. So for people that haven't come across you before, can you tell us, who you are and what you do through CC Mortgages and the kinds of buyers that you usually help?
Sure. Yeah. So I'm a mortgage broker based in the inner north of Melbourne, but essentially can help Australia-wide, which is the greatest part of this job as well. I predominantly do work with first home buyers, but I have first home buyers that are now next home buyers and refinancing and building new homes and investing. So it's pretty broad.
Yeah.
But first home buyers, I would say, a majority of my my clients at the moment, and new clients essentially. So that I started just out of COVID. Had a career change, so I started in property. I studied property and valuations. Worked in property development, real estate sales, marketing. So I've come, instead of a lot of brokers, I guess, coming from a finance or banking background, I've really come from the property side, which I think has been super beneficial in, I guess, my educational approach to broking and lending and mortgage management ongoing. So yeah, it's been an awesome sort of 5-6 years, and I love helping people. So my real passions have always been helping people, finance and property. So mortgage broking was a perfect fit, really.
That's what stood out to me was because you've got the background in property. I find that it's such a big difference in how you can actually help on the finance side.
Yes.
because you've seen the transaction differently. So now you're kind of just seeing it on the other end and matching it and saying, I know what you're about to go through.
And there's a lot more steps than just getting a loan.
Oh,
like,
far out.
the conveyancer and valuations and inspections. And so, yes, the loan is a big part because it's probably the most intimidating part in regards to taking out a large amount of debt. But there are a lot of steps in between. And I think having the understanding of where all the key players come in and being able to help clients navigate that.
And I think that's the huge thing that we connected on. It was like, what we're even doing with the Bodhi, it's like we just need to give them support. Like it's that whole piece of coming together where brokers, as I mentioned to you, I see you guys as the buy psychologists because you're that one that they trust to guide, and they go, oh my God, what do I do? I'm going to auction. How much do I offer? How much do I bid? What do I do? Can you just bid for me?
Yeah.
You're like, I can't do that, but
yes,
let me help you out.
Correct. Yeah. And then sometimes it's quite simple to get a pre-approval. It's, in some sense. And then you're like, oh, I've got that now. How do I do the next part? And I do support clients with that, but that's also great with a Bodhi as well.
We're just there to be an extra help, right? And I think, like you came into broking with like that property development background, but also the valuations I find super interesting because that sometimes makes or breaks a lot of deals.
100%. Yes. And it's really important for clients to understand that a pre-approval, I always say it's it's a hypothetical purchase scenario because you don't have an existing security or property yet.
Yeah.
And the one thing we cannot control is the valuation. So it's just the education around understanding where that sits in the process is really important. But also it can seem really scary because it is in someone else's hands. But often, and from my background, I've, found you can have one valuer do one thing and one do the exact opposite. So like having choice, having options and the education around it and how that part takes its place is important.
Yeah.
And, hopefully you don't get a valuation that comes under, but it has happened.
Yeah.
And it's just having the discussion and understanding what happens in that instance. Yeah.
Yeah. I think that is a whole episode I'd love to unpack with you. I was like, I'm dying to ask more questions about it going, but what happens when we're going to do another episode
at all. Yeah.
It's like, let's just do this from the start.
I know.
And we're going to do that again because like I said, there's so much to unpack in that topic. It's important.
Yeah.
And I think before we go too far ahead, I have to put our no BS statement of the day out there. So if you're new around here, this is where I throw out a bit of a spicy statement that's neither here nor there. But after we talk and by the end of the episode, we'll have Charlie determine whether that is bullshit or not bullshit. So I'll read out today's statement. And it says, getting approved for a home loan does not mean you're ready to live with one. So we won't answer that yet. We'll have some ideas and we'll come back at the end. Yeah. So let's switch into today's topic, which is, going from savings mode to mortgage mode. This is a big one. So when a first home buyer settles and mortgages become real, what's the first thing they usually are underprepared for?
Well, I'd like to think none of my clients are underprepared in that sense. But, if you're not using a broker and you've gone to a bank, you just got an approval and you haven't had that assistance or hand-holding, it's important that you've understood all the additional costs in association with not just the mortgage repayment. So I think you get swept up or can easily get swept up in, I can afford a loan based on XYZ. I've now bought, we've done all this, but then, if you haven't really delved deep into body corporate fees, council rates, because as a renter, you're paying your bills, but you're paying usage. You're not paying service charges and fees and things like that. So,
so true.
We pay to have water provided to our residents when we're owners, and then we pay usage on top. So as a renter, you don't necessarily think about that. And, we kind of pay, $800 to $1,000 a year for the privilege of water. Yep. Then we pay for the usage of it. So it's understanding those things that
it's like not all one and done.
Correct. And I think more broadly, it's the mindset from, yes, we're saving. All that money has now gone to a purchase. So it's gone into an asset, but we now go, well, what's that mindset shift to reduce the interest on that mortgage. And
Yeah.
I'm sure we'll get into it because you go from savings mode to mortgage mode. You now have an principal and interest mortgage, most likely. We want to reduce how much interest you pay on that loan because it's surprisingly and scarily quite large.
I think that's the thing that people don't always understand, right?
Yeah.
And that's that under preparation. Like you said, mate, your clients, I agree, would be very prepared, but because that's why you're here to talk about this topic, right?
100%.
But I think that's the big thing is, when you've grinded so hard to save for this asset, and then you feel like you're at the finish line when you buy it, and then you settle, and you're like, oh, cool, we did it
again.
And it's like, nah, this is the beginning.
Yeah, correct.
And people always feel married to their bank, I found, for that first home. Like they're like, oh, can't.
Yeah.
A quick pause. We'll be right back. Here's a word from one of our sponsors who supports the show. Before you make any property move, you need to understand your borrowing power before you do anything else. Kieran Sood from Deals for Loans specialises in exactly that. She's a mortgage broker with an extensive amount of experience. She'll help with not only your home loans, but also asset finance. If you want to know what you can actually afford before you start looking at property and making the wrong decisions, have a chat with Kieran and her team at Deals for Loans. It costs nothing to pick up the phone and brokers are actually free. So give her a call. Her details are below.
So the mindset shift from, that big hurdle of savings to then that savings is gone.
Yep. It's like, now what?
And now what? You've achieved something great and you've done an amazing job to get there, but now you have this whole new responsibility and almost project to take on.
And I think
with a mortgage.
That's what I want to unpack, right? Because I guess what is that mindset shift that, you try to prepare your buyers for? Like, it's going obviously from saving for a deposit to now managing that home loan. And then trying to plan ahead. How do you kind of help them get used to that idea?
I think with the mindset, I just want to make sure that then going forward, they are aware. I don't like to always talk. There's so many sort of different voices out there, but talking about, I guess, your owner-occupied mortgage being a bad debt in the sense, it's. I don't like using that word, but in the essence, there's a lot of your mortgage repayment that you have that is actually just going to the bank for the privilege of that mortgage, right, which is the interest. So I find it really important to ensure clients understand ways in which over the journey they might not be able to do it straight away, but at any point in that journey while they have a mortgage and they're managing their money and a mortgage, how can we at any point in time reduce the interest that you are paying on that debt to either try and pay off your loan sooner or just, reduce the interest. So it's more the ensuring the clients are aware of ways in which they can do that. They may not be in a position to do it as soon as they've settled, which is totally fine because that's a lot of first-time buyers. They're pumping every bit of money in. We're at a pretty high interest rate at the moment. Cost of living is quite high. So it's understandable that there's probably not a lot of additional income or, funds outside to play with, but there might be in the future and it might be over time. And it's recognizing that we might be in a position over time that we're getting a little bit more surplus. We've got some extra funds, ensuring that they know the best way to sort of utilize that when they have a mortgage in the management of their money, if that makes sense.
No, it does. Like, I think it's like, instead of saying, you now think like that, now think like this, it's like helping them recognize those opportunities. Like, when do you re-engage me? Like, can you use the broker again? Because I think a lot of people have this idea that you can't.
It's like, call me up 2 weeks later if you got a question. Like, that's my responsibility to the clients is ongoing. It's technically for the life of the loan. Hopefully that, it's a lot shorter than 30 years, and that would be my goal, especially for owner-occupiers and trying to pay off their own home loan. Like, utilize us as a service to bounce questions off and just even, just sense check what you're doing.
I think that's the biggest thing that, like, people think you have to pay for the broker, like out of pocket, like an accountant.
Yes.
And I'm always like, it doesn't cost you up
It's
front.
so mutually beneficial,
It
the
is.
relationship, in that, yeah, we do get paid for our work, but we get paid by the lender.
Yeah.
But I work and I'm responsible really for the client.
Correct.
So I always say it's a really mutually beneficial relationship between the client and the broker, because
there's so much to gain.
There is a lot to gain.
Because, I know like with brokers I've used in the past, like when we purchased, calling them like a week or two later saying, oh, I think I've stuffed something up here. Like, oh, should we do this? Like we had to start our loans because we built with two separate loans. We
splits, the land and construction split. Yeah,
exactly. And I remember going, oh, so that's just, we have two interest rates. That's how it works. And I remember the broker said, no.
Yeah, there's restructuring,
refinance. We can look at this, like give it, maybe 2 months and then let's, see where you're at cash position wise. Let's then do it again.
Yeah.
And I'm like, okay, cool. So it's like knowing these small things that you don't just have to deal with it. Or even looking at different lenders, like 2 years down the track, a year down the track.
I think people forget, like, this is not forever what you're in right now.
Yeah.
Lender, rate, product, it can be reviewed, it can be updated. So I get a lot of clients that would ideally like to bank with a more ethical lender, which sounds like an oxymoron, but but they can't based on their position at one point in time. But down the track they could. And that's the same with them, like once you've got a loan, the mortgage mindset being like, we don't have much money now, but hey, ring me up a year later, you've had a job increase or something.
Yeah.
We've now got some more funds. And what can we do with this? How can we make this
like more achievable? Because it's like, you don't know what you don't know. And I think this is like the biggest saying ever, but it's true because for a buyer, like you get so focused and hung up on that one goal that then shifting into this space of managing the money in the household itself and bills. And I think for renters, like you mentioned, that's a big switch because if you've come from living with mum and dad, it's one thing, but you kind of already know based on what they've told you to prepare for, what you're going to be looking at. But when you've come from renting, it's very much like it's all packaged. It's like, yes, I've made my repayments, but now I'm going into a home where, oh shit, I've got to pay bills, like bills.
Yes. Yep.
So it's a lot. And
definitely.
I think I want to talk about the marketplace like landscape because I think, like I said, a lot of buyers almost like pour everything into deposit, stamp duty, fees, moving costs. Like how should they think about having a buffer after settlement? And I think this is where they pour all their money into the house because they really, really want it, but then they leave themselves with very little at the end.
Look, it's a total personal preference, which is something I go heavily in on in regards to, all right, you've told me you've got $60,000 in savings. Is that every single cent you have? Or have you considered the additional costs that you might have? So some do and they go, yeah, we only want to put 60K, but we've actually got 70 and we've allowed for that. Or they go, oh, no, that's everything I have. And so we go, okay, well, let's break that out because you're going to have moving costs. You may have, you also might need to make sure that you've got a buffer for yourself. So for 6 months, 3 months, whatever you want to cover. But it does depend on the priority of that client. So if that client's like, well, I need to use all of my 60,000 to get the property that I want, then it is more of a discussion around, well, okay, how does your cash flow look post-settlement? I think people get hung up also in saying, oh, well, I'll have this money in the future. Banks look at current figures. But that's not to say that, there isn't a time lag here from pre-approval to potentially when you settle, right? Yeah. So there is a potential that a buffer can be built pending on the time. So if you settle, you've got pre-approval and you settle in 30 days, well, we don't have much time to build that buffer.
No.
But if your journey is a little bit longer from pre-approval buying to settling, then yes, if you're comfortable going and have the discipline to.
Which is the hard part.
So I always like to just ensure cash flow wise that it's like, okay, do you live with an emergency fund that if you were no longer working or, could you cut, because this loan is an ongoing liability.
Yeah.
And so if something was to happen, what are you going to do? Do you have personal insurances? Do you, it is so dependent on the client's risk profile as well.
That's true.
But as much as I guess all we can do is just educate
Yeah, and get them prepared.
them on and get them prepared. If they're happy to go, no, that's okay. I'm comfortable.
I'm going to go
I've
all
got a
in.
pay increase coming. I earn a bonus, whichever it may be. Or you've got super conservative clients and go, yeah, I really need to have this money sitting in my pocket. And you go, okay, well, if we have to take that out of your savings total,
this is how much you can
this
borrow.
is how much you can buy. So you readjust your purchase parameters or something like that too.
And I think that's why it's so important that when they're having a conversation with yourself, like this is the stuff you're going through. It's a lot for someone who doesn't know it, but when you've got someone who's like, I do this all the time, just it's all good, and you're laying it out the way you've said it now. It doesn't sound so bad because it's just having options. I think that's 100%. Part of like where people get this mindset of feeling very boxed in with a committed mortgage and like they get scared to buy. And I'm always like, you don't need to be scared. You need to be aware that, there is a lot to gain.
Yes.
But you got to be, it's your risk profile. I think that was an excellent thing to call out.
It's what you consider, like, where's your comfort ceiling?
It's like, do I go all in or do I
and I
have
talk
that buffer?
about comfort ceilings in the lending amount and there's all different areas. So it's like, yes, the bank says you can borrow X, but in reality, look at that number that's coming out every month. How do we feel about that? Doesn't mean that you should. So it's, if a client wants to buy at the absolute upper limit, I support that, but you just have to, as long as they're aware of
where the money goes
and how that's going to make them feel if they achieve that and get there.
Well, this leads perfectly into my next question because I think this is about mortgage repayments, right?
Yeah.
Like, when those first payments start coming out, like what do buyers, I guess, need to understand about where that money is actually going? Because I think there's a lot of like, it's the house, like principal, like this is the conversation about principal and interest only, principal, like all that stuff.
Well, this is where I did write an example because in regards to, so if you've got a standard 30-year principal and interest loan term and you've got your interest rate, if you do break down the numbers, it's a frighteningly large amount of interest that you pay.
Yeah.
So I did $500,000 loan, 6.5% interest rate. I always like to go conservative.
Yep.
Hopefully we don't get that high, but
fingers crossed.
I do always like to run cash flow conservatively.
Yeah.
Now, over 30 years, the interest you pay on that is $637,000.
Oh God.
Yeah. It's frightening.
Yeah.
It's on top of the $500,000 that you've borrowed, right? So when you break that out of a principal and interest repayment, that's $3,160 a month. Of that $3,160, $2,708 is interest.
Jeez.
So at the start, your contribution to paying off your actual property debt is minimal. But I think the understanding of that and going, okay, if I put an extra just $20 a week into that loan manually, I'm going to save $60,000 interest.
So that's crazy.
So
that's it that way.
But that is over a 30-year term.
Yeah.
You have to sort of step back a little bit, do a broader approach. Because not everyone's going to have the ability to have lots of money in the offset or be able to pay huge amounts, but everything helps long term.
Yeah.
And it's understanding how the principal and interest work. So obviously, if rates go up, the bank will adjust your repayment because you still have 30 years to pay that debt off.
Yeah.
So they have to increase to allow. If the rates go down, then hopefully they do adjust and the bank will adjust your repayments because you've got still the 30-year loan term contract. You might choose to then go, hey, I know I can repay at this 6.5%, rates going down, I'm going to stay at that amount and it will make a big difference. So I don't always love pointing it out because it's sort of like it's frightening, but you then have an asset that you're going to work, hopefully it does grow over time and that you are then going to focus on reducing that interest portion by understanding how you can manage that mortgage better with your funds.
I think it's understanding too, like that the asset you've purchased, it's not like you've you've done a shopping spree and you bought some clothes and now you've become bigger and you can't fit into them. It's like, and they're dead investments. This is something that grows with value over time. So the longer you hold it or, whatever your strategy is, when you go to get rid of it, you've earned money on that investment, hopefully.
Definitely,
provided you sell it
Yeah.
the right time and the right price, you've earned money from it.
Yeah.
So even though that is intimidating to look at from my dream is to pay off the mortgage,
Yes.
fully, which that is a goal for a lot of people, I
Yep.
want to pay off this mortgage. There's also the question of, I guess, when it comes to how often you make your repayments. Like, so you mentioned that $20 a week. Now, I remember my broker said to me, switch to weekly payments.
Yep.
And I was like, well, but why? And she said, it'll reduce your interest. And at the time, I didn't really get that. But it's something I wanted to bring up with yourself.
Sure. Look, I always put the repayment frequency down. Yes, there are absolutely benefits to weekly, fortnightly, monthly, but it's sort of how you manage your money. Because if it's going to stress you out that there's a repayment coming out weekly because you only get paid monthly or something, then, it might initially be better to just stick with how you do your budgeting and how you get paid. But understanding the loan setup, the banks calculate interest daily, typically charge it back monthly. So the more money that you have in that loan account, say if you're paying more frequently, your balance is sort of coming down slightly, more in that month, because if you pay weekly or fortnightly, then the interest charge every day. It's essentially, if you pay fortnightly is kind of like the biggest shift between monthly, because there's more fortnights in a year, right? So like that add up to probably one extra month repayment.
Oh, yeah.
Without you knowing it. So essentially you're just paying an extra month's on your mortgage every year. Now, the difference though is if you have an offset account, and this is where it's like how long do you have, Jo? Because we go into this forever.
We'll have to separate this into like 3 masterclass series episodes.
And this is why I find it very hard to keep my client appointments, on track, because to explain if you're in the position to have an offset account, whether you pay weekly, fortnightly, monthly, and it's coming out of an offset account that has funds in it, it's actually not going to change the interest calculation.
Yeah.
Where it is going to change it, and again, depending on the bank, some banks set it up differently. If you choose fortnightly, they're going to charge you interest on that fortnightly, and it actually makes no difference, right? So lender specific, but if you were in that position that all of your funds have gone into that purchase at the start and you don't have that much extra, paying fortnightly is, going to benefit you anyway. Just straight into the loan, because you are paying slightly more off that mortgage, and then you'll find, but again, over time, if you look at it 3 months down the track,
it'll be different again.
Well, but it's not going to seem like you've done much.
Yeah.
You've got to sort of step back and get out of the weeds and give it time to feel like it's benefiting you. But at the start, it's pretty difficult.
I think that's like that long-term game of it will pay off, but you got to kind of let it play out.
Its time.
Yeah, because it's slow. Like a 30-year term or a 40-year loan term is a long time. So to see immediate payoff, it's near impossible. But maybe in a year, 2 years after doing that all the time, that's where you might see a payoff and go, oh, okay, I did make an extra payment.
And I talk a lot about out of sight, out of mind.
Yeah.
If you can automate, say, that extra $20 a week and just not think about it, and you sort of check, you sort of check in annually, see, and you go, oh, actually, I'm slightly ahead of my loan.
Yeah.
Great. But if you're looking at that interest charge every month and be like, it's not going down, it's not.
Yeah.
It's
hard.
It's hard because you're sort of micro looking at it in a.
You're scrutinising it too hard.
Too hard, too quickly, too soon.
Yeah.
Across that 30 years.
Which is part of this mindset, right? It's like, yes, you need to be managing it, but not to the point where you now can't manage it because you're so stressed about that interest rate not changing immediately or the interest going down instantly.
Yeah. I mean, I find clients come back to me and they're like, hey, last month the interest charge was this month the interest charge is higher. Like, well, there's actually more days in this month.
Yeah,
and so therefore, because the bank calculate interest daily, that interest charge potentially that month is 31 days as opposed to,
30, yep.
And so you're going, and then that's stressing someone out, but that is it's just the setup. That's the design of the mortgage, how it works.
And it's like, and with that mortgage, you've got a house. It's like there's a trade-off somewhere.
Yeah.
Someone's got to get paid, and it's the bank.
Unfortunately, it's the system.
Yep, that's what setup is.
It's sort of out of our control.
Yep, pretty much.
And don't let that, really get you down, stress you out. If you have the mindset up front that and you have ways in which you can save your interest or pay extra into your loan or everything's going to help.
Yeah. Then
long term.
Well, this brings up the products, right? Because you mentioned exactly what I wanted to talk about, which is the offset, the redraw, fixed variable and repayment choices. There's so many ways and so many products out there that every bank offers. So I guess I want to talk about offset accounts because people, I think, misunderstand this the most with how it works.
Mm-hmm.
So in normal person language, what is an offset account and how does it help? And what do buyers often misunderstand about it?
Sure. So, look, fundamentally to the bank, an offset account is a transaction account. Like it's your everyday spending account. That sits in your profile, your banking profile, say your online bank. So you've got your scary line item that says negative 500,000, for example. And then you have another transaction account. Now, that just works like any other regular bank account.
Yeah.
I like to speak of them like savings accounts, however, even though technically in the bank size it's not a savings account, but let's just call it a general bank account. Now, when the bank calculate interest every day, they will and you have an offset account, any dollar in that offset account is taken into their calculations when they charge or calculate the interest. So if you've got $10,000 in an account that sits next to your loan and that loan is $500,000, the bank go, okay, loan minus offset account balance is $490. We will only calculate interest on that $490.
Yeah.
So that in very high essence is how the offset works. Banks can allow multiple offset accounts. You can have one. It often costs you to have an offset account.
Yeah.
So that is always part of a conversation, whether it's going to be worthwhile to you or not. But essentially, the offset account is just another account that you can put money into. It's your money because it's in your name. But it will essentially help and offset the interest charge on your loan.
See, nice and simple.
It's sort of simple.
No, and now I want to talk about redraw, right?
Yeah.
So different from offset. What are the pros and cons that buyers should understand before relying on either one?
Okay, so understanding a redraw is essentially not another account.
Mm-hmm.
It's money you have paid over and above your contractual loan repayments into the home loan. That then becomes available as an available balance to you. So same example, you've got a $500,000 loan. You've moved $10,000 or paid that into your home loan, paid it down. You're technically $10,000 ahead of your contractual term on the $500,000. That becomes an available balance to you that if you need, you can redraw that back out.
Right.
The difference, I guess, is that it's kind of you're technically re-borrowing that from the bank because you've paid it to the bank and now you're going to re-borrow it. Again, time for a whole other discussion in regards to how that can affect you in its purpose for the re-borrowing. But I think they're super underrated.
Yeah.
Redraw. I think if you're in a position that one, they're typically fee-free, you just got to check the terms with the lender, but usually there's a minimum $1 to redraw out, which is fair enough.
Yep.
I like it that it creates a barrier to redraw. So when I personally first got my home loan, I out of sight, out of mind, made all these extra repayments into that loan. I wanted to pay it down. I didn't want to touch my redraw because I could see that balance was going down. I could see the available balance going up, and I looked at that and it's like, hey, I'm ahead of my mortgage by X amount.
Yeah.
And it was just sitting over there. I knew I wasn't paying
Yeah.
interest on the full, you know, it was
Amount.
again whatever you had in there. It depends. If you're going to have surplus funds and you know that over time, then and you want easy access to it, an offset account is a good one to consider.
Yeah.
If you're not and you're really going to be sort of running pretty lean,
Yeah.
then a redraw is perfect. And then you could make that manual $20 a week transfer.
Yeah. Transfer.
Right? So they both serve a purpose. I think a deeper discussion down the track is when, and probably so many people have probably seen social media videos about it for investment purposes and things, and that's for another day. But I really think for first home buyers, it's just going, what's going to be your position post settlement?
100%. I think
and it can be reassessed.
That's the other thing too.
We can change the product. If you start on a redraw, and then it gets to a point that, hey, I've got all this money extra, I wanted whatever it may be, and it goes, well, maybe it's now time to look at that offset account option. That's what you call us up for.
And I was going to say, this is why you use the broker. If you're not sure, or it looks like you're just misunderstanding the products, because it is overwhelming when you go to the broker for the first time and you start hearing offset, redraw, and you're like,
we haven't even touched on like fixed rates too.
I was going to say, this is another one that's on my list, is fixed rates. Like there's so much to this process, but I think from that variable rate versus the fixed rate, like let's talk a bit about that, because I think a lot of people love that fixed rate interest rate. Mm-hmm. And then the best example I could give you is after COVID hit, right? Interest rates I think were like 2.6 something, or really low.
Yeah.
And then all of the people that got their home loans at that point, locked them in for 3 years at a fixed rate, had a heart attack 3 years later.
Yeah. Yeah. Yeah, I know. I had clients 4 years on 1.89.
Oh, they would have cried.
Well, it's amazing in the 4 years, right? But yeah, to come off that needed a bit of preparation.
Absolutely.
Right? And they absolutely have. So fixed rates serve a purpose, I think, mostly for like making you feel comfortable if you have a portion of like an element of stress around your repayment moving.
Yeah.
There are huge benefits to fixing a rate like that when they're low and competitive, and you don't have to fix all your loan. You can do a portion of your loan. You can you can have split loans, and it's just important to understand. So you lose an element of flexibility when you fix.
Yeah.
In the sense that most banks don't allow offset against a fixed rate loan. So a lot of people don't understand that.
Yeah.
They also don't understand that they can't just fix, the variable rate's this, I'll fix it for that.
Oh, yeah.
That's not how it works. There are particular fixed rates for 1, 2, 3, 4, 5 years, and they are not the variable rate.
Yeah.
So that's another misconception. There's like, if we lock this in, fine. If you lock it in, it's not that rate. It's going to be the different one, advertised rate. And I think it's more to give comfort. So, and what I mean by that is that if you want to know for 2 years that your rate is going to, or your repayment is going to be X.
Yeah.
And that will just get you through a 2-year period of uncertainty, and you're happy, you feel comfortable with that. You know you can make that repayment, great. Just ensuring that you understand that if rates come down, you are fixed to that. You can get out of it, but there's penalties. Again, this is what it's like the
pros and cons.
The pros and cons. So the flexibility is not there. So you can't save interest on an offset. There'll be a limitation on how much extra you can repay into that fixed rate mortgage. But if you know that, you might have a kid coming along and you're taking time off work and your income's going down for a certain period, and you've done your cash flow and you go, we know we can do this. We're just going to hedge our bets for 2 years and do that.
Yep.
If you're doing that, then turn off put your blinkers on to everything else outside, because then
it's not impacting you.
Because you've chosen that. Other things like locking in that fixed rate for a period of time. So in terms of you haven't committed to the loan yet and, you need to, because banks could email me at the end of the day today and say, hey, all our fixed rates are changing, close of business to this.
Oh, shit, that happens.
Yep.
Yeah.
So we don't really, this is where like the sort of the variable sits around what the RBA, cash rate is, technically should be, but, the fixed rates are sort of the banks at the bank's discretion.
Right.
So sometimes there's a fee. So if we're in a pre-approval stage or, you've bought but you're not selling for 90 days, you have to choose whether you're going to hold that. If you want a fixed rate, are you going to pay a fee or are you going to run the gauntlet? There is a lot, and I think it's really specific to circumstances at that time, what, you're doing, and just ensuring you understand
the differences.
Yeah.
And you've done a really good job at explaining that. I think it was actually really simple to understand that, like the way you've phrased it and positioned it, because it's exactly what I was wanting. Like when I was talking to you, before we jumped on, I'm like, you're just the right person to explain this. Good. Because even when you were talking to me, I'm like, I feel like I wish I knew about you when I bought my house about 4 years ago. So that would have been helpful.
But this is where it's like, it's hard to keep meetings in a certain time because there's it is so
dense.
much. It's dense, and it's I like to have that education approach up front because it's just understanding the differences and how it could be a benefit or a hindrance to you. In the end, it's your decision as a client, 100%. But if I can lay it all out, and you have that understanding.
I think long term though, it pays off to understand. Like you have that appreciation after when someone spends the time to explain it, or just knowing that you can call that person again to say, don't stress. Like you can call the broker and go, hello.
Yes.
What the hell am I doing here?
It's so easy to probably dispel over a pretty quick conversation.
Yeah, 100%. And I think, one other thing I want to talk about, I guess, is like who it affects and how, right? So like, who do you see this impacting the most? Like buyers who have stretched themselves to get in like this mindset of like saving, and then, trying to manage their home loan, doing certain things with either redraws or offsets and not understanding how they work. Like, what do you see? Is it buyers who have stretched themselves to get in, or is it buyers who have not been properly taught how the loan works after settlement? Like who's impacted more, do you think?
Or I had a very good example just of a client, I guess a generational shift or differences. I think current first-time buyers now are really open to the financial education around loans, and I would hope are pretty informed going in. So whether they choose to be stretched to get into that house, that they have done that, understanding what position they're going to be in, and the example sort of I had is was an older generation client who wasn't mine, came back to me. Had a loan set up, was really just like, these banks are taking too much of our money, which, yes, like that interest calculation is huge. Where, like, it's crazy that it's like, the banks are going to get that more than what I've borrowed for the house, right? So there is this this negative
perception of
it. But he's like, I don't want to give the bank any more of my money. And he had $50,000 sitting in a savings account not associated against his loan.
Oh, which could be offsetting all that interest.
Correct. And I sort of said, you don't want to give the bank any more of your money, but if you put that money against your home loan, they can't charge you the interest on that portion where you're paying tax on the interest you're earning on that money over Bank X when you're with Bank Y with your loan. And that, I think, it's just not having that education has really he hasn't really seen it, because
he could have been benefiting for so long,
for so much longer.
Yeah.
I think I guess the silver lining of clients getting loans now, fingers crossed, in the fact that hopefully we are at a bit of a rate peak.
Yep.
Fingers crossed. Banks add a 3% buffer when they're assessing you at the rates. So if you're getting a loan, and this is the difference between pre-COVID or, just post-COVID when rates were 2%, at a 3% buffer, they were servicing test at 5%. We're now at 6%. So technically those lend buyers at that time, if their circumstances have not changed that much, are kind of now lending outside of their means, the means test. We're at 6%. Banks are assessing you at 9%.
Far out.
So it has affected a lot of people's serviceability, but I always see that in a bit of a positive way, that it's really conservative.
Yeah.
In that
they've overestimated.
That. So yes, they haven't given you as much borrowing power, but in a way, if rates do start coming down or slowly or a slight shift, you can only be in a better position.
Yeah, I think that's a really key thing that you said, that you're being assessed 3% above, right? Yeah. So even though the rate is at, let's say, 6%, you're being assessed at 9%. Yes. So if you're still getting the lending and you're still allowed to buy a house at that point, they've kind of predicted that, okay, if shit hit the fan, we'll still lend you the money because we can see that you're able to make the repayment. So then you're only in a position of, like you said, hopefully we've hit the limit, but, it comes down and then it's a relief, not this
and your
shock
cash flow
factor
is stronger.
Yeah.
It means that you could keep your repayments where they are and then you're paying more off your loan quicker.
True.
Things like that. So it's
like perks and benefits, like perks and cons.
Yes, a 2% interest rate would have been amazing.
Oh, yeah.
And when we all love that, but also a low interest rate, not the greatest sign of a good economy either. So, it's
you got to take
it. And I think it's understanding that interest rates are really so much out of our control.
Oh, yeah, they are.
So I think the 3% buffer is a good one to sort of consider. But I guess sort of back to your question, people who've stretched themselves or not probably taught, there's probably a bit of a balance. I'd probably say it's the ones that haven't been educated enough have probably impacted the most.
100%. I would agree, because there's a lot of people I can imagine sitting out there with home loans that are listening to this going, shit, I haven't touched my home loan in like 10 years. I haven't looked at it. And now probably thinking, oh, crap, I should look at it.
Yeah, and I mean the tricky part, unfortunately, some people are mortgage trapped right now because of the 2% rates. As I said, 3% buffer is 5%. They're now assessing them at 9%.
Yep. So
you might not be in a position to. So it's just, the cash flow management and things is really important.
100%. A quick pause. We'll be right back. Here's a word from one of our sponsors who supports the show. If traditional networking feels stiff and transactional, then Lux VIP is something completely different. Good food, good people, real connections, and genuinely fun events that stand out from the usual business crowd. If you want networking done differently or just want to have a bit of fun and meet the right people that will help bolster your business forward, then come along to Lux VIP events. Talk to Steve McMiniman. His details are in the show notes below, and he's the one who runs Lux VIP events. Come and have fun with us. I'm part of the crew, and so are all or most of our guests. So come and have fun with us. We'll see you there. And this brings us to our fan favourite segment, and we're nearly at the end, which, I think we did pretty well.
We did, yeah.
So this is our Reddit Real Talk. Yeah. So every week we have listeners that submit now to our inbox daily. Shout out to you guys for doing this. And you send us stories that you want us to unpack with a professional. And I thought this was a great one to do with you. So let's get into it. This person has written in and said, is paying nearly all interest at the start of a loan standard? We bought our first home and moved in early December, paying $1,800 a fortnight. Since then until now, the mortgage has barely budged. It's gone down maybe $1,000 in 4 months. I assumed the $1,800 would be partly mortgage and interest, but it all goes to the mortgage. Then the bank charges me nearly every cent of it back in interest. I'd bought here as a first home after being told it's a good idea to buy a first place and pay some off and then sell and buy closer to where I want to live, when you're a bit better off. But if I'm paying only interest, I feel like I've made a mistake. Will I be paying almost nothing but interest for years? Thanks. Edit. I'm not in danger of losing the home or not meeting the repayments. I just meant I possibly made a mistake when it came to plan to move somewhere else in a few years. I probably wouldn't be able to afford that either way, so not a big deal. Okay, Charlotte, if
It's a
this,
lot.
it's a lot. So
Yeah.
if this first home buyer came to you, with this exact concern, like I'm paying so much, but my loan's barely going down, how would you explain what's happening and what practical things they could do from here?
For sure. So I guess it's really similar to the example I touched on earlier
Yeah.
in regards to of that principal and interest repayment.
Mm-hmm.
Significant amount is interest.
Yeah.
It's unfortunately the reality of a
It
home
is what
loan.
it
It
is.
is what it is. I think this listener, they're too micro and it's stressing them out.
Yeah.
And that is where it's the long-term view of it is probably a bit more important.
It goes back to what you said. It's like, you're micromanaging it too far.
Yeah.
Yeah.
And if you're looking, and I mean, December to now, it's only 6 months of a 30-year term, right?
Yeah.
Unfortunately, yes, when you get the loan, it's at its highest.
Yeah, it's like
The
that's
interest
one that
is at
hits
its
you.
highest. It's, all the numbers are at the biggest,
worst.
most intimidating amount. And you've also just let go of all your savings. I understand that, like, the idea was it was a step,
Yeah,
a stepping stone. And that's not to say that it can't be. I guess, again, only 6 months in a market. Also, you would probably need, ideally that property is going to gain value over time.
Yeah.
And you will slowly pay that down. And then there's going to be a bit more of a gap in, I guess, what your capital or equity in that property is.
Yeah. And then you've got choices to then move on when that equity's come up, like the valuation gets done and
Correct.
you can go, right, okay, I'm, 100K ahead.
Yep.
I could,
And that is where, say, annual reviews are really important. That you do a check, you do a sort of property report annually and be like, where's that sitting? Because then you can sort of make plans around, okay, if the future goal is to upsize, maybe you do need to start paying a little bit extra off your home loan.
Yeah.
To make that gap a little bit bigger, a little bit sooner and stretch it out. And I mean, it's like they said, they're not in danger of losing the home or meeting the repayments.
Yeah, which is a good thing.
Which is great. I think they're just micromanaging it too much and over, I guess, analysing the numbers so soon.
Yeah, because it's only 6 months in, like you said, to a 30-year term potentially.
Correct. And that goal of upsizing can absolutely still be there.
Yep.
But it's, things to put in place would be maybe you do pay a bit extra into your loan. Or what's your cash flow? What's the surplus every month or fortnight?
Yeah, extending that out.
And ensure that you're using, like, if it's quite excessive surplus, maybe the offset is there and it's gathering all of that and it's going to sit there and build up over time. That becomes part of a potential deposit for a new place. You have to,
You've got options at that point.
So many options. But yeah, I think the tricky part is it's just such early part of
the journey.
And maybe it wasn't pointed out that, unfortunately, yes, of that.
There is interest.
There's a significant amount of interest. So, do what you can, when you can, if you have the ability to, just to put things in place so you can reduce that interest.
100%.
Yeah.
I think thank you for answering that because it was like when I found it, I'm like, geez, this is so similar. But like it's something that I think a lot of people struggle with. So, very well answered and shout out to our listener who submitted that one last week. That was a good one.
Yeah, definitely. No, it's great that they're so on top of their loan.
Yeah.
And they're aware of it. It's just the unfortunate reality.
It's like, don't overcook it. Be good.
Yeah.
Keep going.
Keep going. Just head down, butt up, like.
Yeah, it'll work out.
Yes.
I love it. And I can't believe we've come to the end of our time.
Yeah.
I think the one thing I want to come back to is our no BS statement. So at the start, I threw it out there and I want to get your verdict. So just a reminder, it was getting approved for a home loan does not mean you're ready to live with one. Do you think that's bullshit or not bullshit?
Absolutely not bullshit, no. No, it's a huge other important step. Ideally, though, you are prepared when you do have that mortgage, though. But life changes and things happen. So get on the phone, ask questions or reach out.
Yeah. What does it mean for
check.
you?
What does it mean? If you've come in every scenario is different. Come into inheritance, got a pay rise, you've lost your job. There could be, it moves both ways, and it's, I think getting the loan, as I said at the start, it can be quite quick. It can be quite easy.
Yep. It's
the reality of the maintenance of it after, and how to put you in a positive ongoing position.
Yeah, and talking to your broker when these things happen, if you don't know what it means, calling them
Definitely.
back and saying, I lost my job, what do I do? And often the broker's trying to help you to manage it. They don't want to see you go, oh, that sucks. Well,
yeah,
let me know if you can't make let me know if you can't make the repayment.
Yeah, no, that is not, yes. And that's
total opposite of what you guys do.
Definitely.
No, and Charlie, one last thing, I guess for someone listening who is maybe about to settle on their property or they're coming close or has just settled, what's your final piece of advice to them, like in this period or transition that they're in?
Well, it's very exciting. It's don't forget that it's a massive milestone and sort of huge achievement to buy your first home.
Yeah.
Notwithstanding like probably a lot of hard work and effort and in saving. So it is a really enjoyable time. So I guess one of it is to enjoy it and not stress too much about it. But post-settlement, just if you've got questions, reach out really quickly so you get an understanding of what our ongoing position is. And we, typically 6 months sort of have a review, and then every 12 months after that, you're going to review it anyway.
Yeah.
Like a health check on the loan. And reach out to your broker. Ideally, they've reached out to you first if you've used a broker.
True.
Also, if you haven't used a broker and you've got a loan with the bank, you can still reach out to a broker.
Yeah, that's good tip to put in at the end.
It's not like, oh, I didn't use a broker, I'm stuffed. I'm stuffed and I'm stuck with this bank. Reach out to a broker. They will give you help and advice. Oh, well, I would anyway,
Oh, well, you'd hope so.
So, but you should be prepared. Hopefully you're prepared. You feel comfortable with that cash flow. You know, okay, this is our loan. These are going to be our repayments.
Yep.
Don't get stuck in the weeds. Step back, enjoy that achievement, and then think of it as a broad umbrella. 30 years is a long time. You're not locked in for that 30 years with that lender, with that product. Things can change.
Yeah.
So, yeah, don't let it stress you out. Enjoy it.
Yeah.
And
enjoy
just
the process.
Yeah, and hopefully you feel prepared. And if you don't, get some help and reach out.
Charlie.
Yeah.
This has been so much fun. I absolutely loved this episode because I love it when we get a new topic that we haven't really unpacked, and you've done like a really great job at, educating people today on a broader scale. So thank you.
Pleasure.
Of course. And thank you to our listeners for always tuning in. As I always say on this show, it costs nothing to reach out and have a chat. Like in general, just pick up the phone, ask a question. Like if it doesn't lead anywhere for you, like just do it. That's the hardest part, is just picking up the phone. Yeah. So for first-time buyers, you need to understand how the loan actually works and how it becomes part of your real life. So reach out to Charlie. She's really passionate about this space. This is exactly why we had her on the show, and I'm sure she'd be happy to chat to you.
Absolutely. Yeah, anytime.
Love it. And thank you again, everyone, for tuning in. I'm Jo Agresta. This has been the No BS Real Estate Podcast. If you want to connect with Charlotte, her details are on screen and in the show notes below. And if you're on the Abode app, then you'll see Charlotte's profile on there. You can connect with her there too. Thanks so much. We'll see you next time. That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abode AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abode.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abode AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abode.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.